What's up, everybody? Today we're going to be taking a look at three companies, all of which the numbers look promising. All three look like they have the potential to be a deep value opportunity today. But in investing, only half of the game is analytical. Only half of the game is looking at the numbers of the company. The other half is asking ourselves, what is the future of this business? What is the story here? What are we betting on when we make an investment in this company? We're never going to be able to predict the future for certain. But when we make assumptions about the future of a company, really what we're doing is we're combining that analytical side of things and the story side. What do we believe the future of this business is, and how are we representing that in numbers? A lot of what I do when I look for deep value companies is I'm just turning over tons and tons of stones. I'm trying to look at as many potential opportunities as possible. I have a lot of companies on my watch list at this point. So what we're going to be doing today is turning over three stones, looking at three companies where the numbers, the fundamentals of the business, they already meet my criteria for deep value potential, but we have to look at the story. We have to see, what is it about this business? Why is the stock so cheap? Do we want to stay away, or do we want to make an investment here? I think the first one is a company that most investors will be familiar with, but I think the other two, it's likely you haven't heard of these companies before. So I hope to show you something new. I think the third company is looking especially interesting right now. And if you get value out of the video, subscribe to the channel. We just passed 2,200 subscribers on here, so thank you so much to everyone who's followed. Now let's dive into the first company. Even if you haven't looked at their stock before, I'm sure you're familiar with their products. The company is Crocs. They, of course, make Crocs shoes, and if you've been invested in the stock, it's been a wild ride. Crazy run up in 2020, 2021, and then all the way back down again, and it's just been a bit of a roller coaster. On their recent earnings report, stock dropped a ton. It was down about 30% 2 weeks ago on August 7th, and it's pulled back a little bit since then. And during this time, during the past 5 years, the revenue of this company has absolutely soared. You see here that they were about $1 billion, a little over $1 billion in revenue for over a decade, and then it just shot up. Now it's sitting right around $4 billion a year in revenue. Now, part of this increase is in 2022, they finalized an acquisition of a smaller shoe company called Hey Dude. They make these kind of shoes here, and with this acquisition, that added on, almost $1 billion in revenue. So some of this gain was from that acquisition, but most of this gain was organic growth in Crocs. Incredibly enough, Crocs seems to have had this surge in popularity. Now, I'm certainly not an expert on fashion, but part of the reason that I've never been too interested in this company is I just think the shoes look ugly. I heard someone once describe them as the unfortunate offspring of a flip-flop and a pasta strainer. So I thought they would kind of die out. I thought they were a fad. Maybe they're not. I'm not sure. When we try to decide if Crocs is a good investment today, though, that's really what it's going to come down to. Do we think the next 5 to 10 years are going to look like the last couple years, like 23 and 2024 for Crocs? Or do we think this jump up in revenues is going to be followed by a slide back down? At the current price today, Crocs is trading for just 5 times forward free cash flow. Just 8 times forward earnings. So by the numbers, it looks really cheap. But I have a few concerns about this company. First of all, their next quarter guidance, they're calling for revenues to be decreasing 10% year over year. That's a pretty big drop, and they're also saying that margins are going to be pulling back as well. Now, some of this margin pullback, they say, is from tariffs, so we won't hold that part against them too much, but 18 and 19% adjusted operating margin, that pullback is more than just tariff headwind. This company has been at, mid 20-ish percent. Tariffs are only accounting for 170 basis points of headwind here. So to me, to someone who's already worried about the fact that the demand for Crocs could just be going way down in the future, this doesn't ease my concerns. Another big concern of mine, the next slide in this presentation is capital allocation priorities. And I have to say, this company has not been good at allocating capital. One of the main jobs of management, if not the main job of management of a company, is deciding how do you allocate capital? Do you want to put money into growth? Do you want to pay down debt? Do you want to return capital to shareholders in the form of dividends or buybacks? They highlight 3 areas here: invest in our brands, debt pay down, repurchase shares. In my opinion, in this company's recent history, they've done a pretty poor job at all 3. I'll start with just invest in our brands. As I said, a few years ago, Crocs bought Hey Dude. They bought Hey Dude for $2.5 billion. A little over $2 billion of that was cash, and almost $500 million was in stock. Keep in mind, Crocs right now is trading for about $4.5 billion. So they spent more than half of their current market cap on Hey Dude. Hey Dude makes up about 20% of their sales. Not even actually, 19% of their sales. It also has lower margins than Crocs, and it's not even growing. The last quarter sales declined 4% year over year. Does this seem like a good decision for management to pay $2.5 billion to buy this company? In fact, they know it was a bad decision because recently they took a write-down on their Hey Dude assets. They took an impairment to their goodwill. And for clarity, these are non-cash expenses. These are an accounting expense. So this is making the earnings look artificially bad for the last 12 months, but it is an acknowledgement that they overpaid for Hey Dude. They overpaid by a lot. Now, repurchase shares. Crocs has been buying back a lot of shares, but they certainly have not been opportunistic about it. They bought back over $1 billion worth of shares in 2021. This is really when they were doing buybacks. In 2022, by the way, they bought back essentially nothing. If we just look at the stock, 2021, this is when they were at their most expensive. This is when they hit their peak. 2022 would have been a much more reasonable time to buy back stock. But this is a big problem that I have with the way many companies do buybacks. Buybacks are great, but the price that you pay matters. There are a ton of companies that buy back stock when the shares are close to all-time highs, and then after they crash, then they're scared, then they want to hold on to capital. So the end result is that in practice, buybacks, whether they're good or not, depends a lot on management. There are some companies we've looked at like Stone Co. who were aggressively buying back stock when it was around the $10 range. And then as the price goes up, they slow down. Alibaba is another company. Alibaba was very aggressive at buying back their shares under $100. Now they've slowed down as the prices come up. That is exactly how it's supposed to work with a company. So coming back to Crocs, I have some long-term concerns about the demand for the actual product. And also management has been really bad at allocating capital. As far as what I might expect in my base case, I mean, if I have revenue declining a little bit year over year, so maybe 3% every year for the next 5 years, I assume their operating margins are, 17, 18% maybe. Free cash flow margin has been about 12%. And if I give them maybe an 8 times multiple, 9 times multiple, I'm just not getting enough return here for me to be interested. So even though it looks super cheap, the numbers look incredible. It has a double-digit free cash flow yield right now. So yes, if they keep growing the top line, if margins remain strong, this company is going to be a great investment. I just have too many doubts. I have too many question marks. So it's going to be a pass for me right now. I'm going to keep it on my watch list. Maybe I'm letting my bias from just my personal opinion about the shoes affect my assumptions that I'm making a bit too much. So if you have a different opinion about Crocs, let me know down in the comments below. Now let's move on to the second company. The second company is called Nice. This is not a company I was familiar with until fairly recently. The business is broken down into a few segments, but where they make the vast majority of their money is this first one here, what they call customer experience. Essentially what they do is they run call centers for customer services. If you want to call up, UNH or Delta Airlines or whoever, you're going to get a call center most likely. And a lot of times those call centers, they're not necessarily run by the company you're calling. It's just easier for them to outsource it. It's more scalable. So instead of a bank, for example, having its own call center infrastructure, they'll just subscribe to a call center as a service company like Nice here. And they'll handle all the calls, all the live chat, all the chatbot interactions. They'll deal with all the analytics. They're investing a ton in AI for their customer experience platform. And they are definitely one of the market leaders here. You see, they have a ton of clients. I'm sure you recognize several dozen of their customers here. We have 3M, CVS, Walmart, Target, UNH, Charles Schwab, Marriott, Disney, American Airlines. You get the point. They're one of the market leaders. I like investing in market leaders. In fact, I love when I can find a market leader in a relatively small niche. A quick look at the fundamentals of this company paints a really good picture. They've been growing very nicely. Not only has the top line been growing at, low double digits, call it, just over 10% over the past decade, but they've also been increasing margins during this time. Operating margins have gone from high single digits now to close to 20%. A company that's able to grow the top line, grow revenue well, while improving margins, that's definitely a sign of a company that is increasing their competitive advantage, that is improving their position in the market. Debt is also very low, free cash flow is looking good, and the company had been slowly increasing shares, but now it's slowly decreasing shares. So they've stopped diluting shareholders. There's really a lot to like here, and the share price, the stock, it's been more than cut in half since the end of 2021. They were over $300 a share. Now it's under $140. Right now, the company is trading for roughly 15 times operating income, about a 7% free cash flow yield. So pretty reasonable. Definitely seems on the cheaper side for what appears to be a quality business. It doesn't necessarily seem dirt cheap yet, but on a forward basis, ticker has this company trading, between 10 and 11 times forward free cash flow, between 10 and 11 times forward earnings. So I'm definitely interested in this business. Another thing I really like is a lot of their revenue is recurring revenue. Most of their growth has been in cloud, their CX1 platform that they talk about. That's this blue bar here. And pretty much all of that is recurring revenue. We see that right now, the percent of their revenue that is recurring, essentially basically subscription revenue, it's about 90%. That's great to see. It makes earnings more predictable. Companies don't switch their contact service center provider too often. It's annoying for them. They would have downtime. One company like NICE, they have all the data, all the analytics, everything they need to manage a certain company, like take Marriott, for example. They have all the analytics, all the data they need to manage Marriott's call center services. It would be annoying to them to switch to another company. So I think you're going to see just slow growth out of NICE going forward. Their guidance that they're looking for this fiscal year is about 7% on the top line, 12% on the bottom line. In terms of earnings per share, they're looking at, $12 and change in earnings per share. Again, this is a stock that is trading for a little under $140 right now. So just a bit over 11 times this fiscal year's earnings per share. All in all, I think NICE looks really attractive right now. It's a company I'm definitely interested in. I'm going to dive a bit more into the sector. I want to look at some of their competitors. The main players in this space are Genesis Cloud and also Five9, if you've seen this stock. So I just want to take a look at their competitors' earnings, see what they're saying as well, before I put numbers into my assumptions for the future. If you've looked at NICE stock, or if you have any insight into this sector, let me know down in the comments below. Since I'm less familiar with this space, I would definitely love to hear from anyone who's been looking at it. Now, let's move on to the final stock. This is a company I've looked at once before on the channel. A user asked my opinion on Nomad Foods. This was a couple months ago, I think, and I was not familiar with the company then, but I made a video on it. I'll put the link to that in the description. And essentially that video is about how I look at a company if I've never seen the company before and I just want to take a dive in and see, is this interesting? How do I start thinking about the valuation of a company that I'm unfamiliar with? And I think Nomad Foods was a perfect company to choose for a video like that, because not only do I think that there's some value here, the numbers certainly look interesting, but it's one of my favorite types of companies, which is just a simple, boring company. This company sells frozen food, mainly fish, also vegetables, some chicken, but it's a very simple company to understand. Anyone can look at their presentation, read the transcripts of their calls, and understand this business. On top of that, they're a market leader. As I say, I like investing in market leaders, especially if they're the leader in a niche market, which this company certainly is. They are the leader in European frozen food. It's not a cool or high-tech business, and there isn't crazy growth here. This company has grown their top line by about 6%, and some of this growth is through acquisitions, so the organic growth is probably, low single digits. Basically, organic growth is probably roughly matching inflation here. Margins have been incredibly stable over time, 11 to 14-ish% margins for almost a decade. They return a ton of capital to shareholders. With the price low for the past 3 years, the company has been pretty aggressively buying back shares. Also, the insiders have a massive amount of skin in the game. The two co-founders both own significant stakes in the company. The CEO, who's not one of the co-founders, also owns quite a number of shares, so it's great to have them aligned with us common shareholders. Now, the stock is down recently, essentially at a 52-week low right now. And part of that is because the last quarter's earnings, they weren't great. Revenue was down, costs were up, so margins were down. Overall, it didn't look great. They lowered their guidance. They're saying revenue is going to be down for the year, earnings going to be down a bit, but still they're calling for about $1.90 to $2 a share in earnings. This is a stock that is trading for $15 right now. They're not even trading for 8 times earnings. On the earnings call, management said, yeah, the numbers don't look great, but look, we had a really hot summer. A hot summer means that demand is down for a lot of their products like frozen fish. And on top of that, a hot summer means costs are significantly up for a lot of their vegetables, for peas, for potatoes. There were some issues with drought in the UK, and they were saying that, the reason that margins don't look great for this quarter is it was just really hot and that increased costs. Going back and reading through a few years of earnings calls for this company, I think that management is trustworthy. I think that they have mostly made good moves and run this business fairly well. Yes, it is a slow growing company, but I'm not sure that they deserve to be judged so harshly for this quarter. My base case for Nomad is they're just going to grow in line with inflation. I'll give them, 2 to 3%. I think operating margins stay basically where they have always been, about 12% operating margins. I'm going to give them an 11 times multiple, and I'm looking at a boring frozen food company that is just barely growing on the top line that I think we could get a 22% annualized return on over 5 years. In other words, I think this boring business of Nomad Foods, it might be the most interesting of the 3 stocks that we have looked at today. Just so you know, I do not own a position in any of these 3 companies, but I'm seriously considering entering a position in Nomad. As always, nothing here was advice to buy or sell any of these stocks. This is just my opinion. If you own Nomad Foods or if you're looking at this company, let me know. What do you think? What am I missing here? I would love to hear the bear thesis. Again, if you got value out of the video, subscribe to the channel. If you agree or disagree with anything I said, let me know down below, and I hope to see you all in another video.